Hello guys, so today I want us to talk about the accounting cycle. Now, what you need to understand is that there are various steps in the accounting cycle. So um, I'm going to summarize them. Number one, the in the accounting process, you need to have the transaction. That's number one. Number one, you need to have a transaction, right? Then number two, you need to identify source documents from the transactions. After you've identified the source documents, then you'll have number three, which is the journals. You'll be able to prepare the journals. Then from the journals, you will have number four, which is the general ledger. So you transfer all the accounts in the journals to the general ledger. Then from the general ledger, you will have the trial balance. You extract all the balances and accounts from the general ledger to the trial balance, right? Now, after the trial balance, you will be able to draw up your financial statements. So we said the journals are three, then the ledger is four, now the trial balance is five, then the financial statements is six, right? Now the financial statements are divided into various components. I'm going to brief you on them. Um, the first one is the statement of financial performance. It's also known as statement of profit or loss and other comprehensive income. But the most commonly used word is income statement. So we're talking about the same thing. Income statement is the same as the statement of financial performance or the statement of profit or loss and other comprehensive income, right? Now, you also have a balance sheet. That's number two. Balance sheet, it's a component of the financial statement. So a balance sheet is now called the statement of financial position. Now, number three is the statement of changes in equity. So it's also called the statement of changes in net assets. Now, the fourth one is the statement of cash flows. So it's also known as cash flow statement. Now, the other one is after the statement of cash flows is the notes to the financial statement. So it means you have five components of financial statements. Now, we after the financial statements, the last step of the accounting cycle is the analysis and interpretation of financial statements. So basically, it's known as ratios. You calculate ratios and then you comment on them. That's the last one. So it means for each and every transaction, you need to accomplish all these steps. A transaction needs to start from the transaction to the source document, the journals, the ledger, the trial balance, the financial statements, up to the last one, which is the ratios. So um, it means that a journal is very important because I mean the transaction is very important because everything else depends on a transaction. The source documents depend on a transaction. You cannot have a source document without a transaction. The the journals depend on a source document. You cannot have journals without a source document because you rely on the source document before you decide which journal to prepare. You must have source documents. Then you also cannot have a general ledger without the journals because the general ledger is dependent on the accounts from the journals, right? Now, the other one, which is the trial balance, you cannot have a trial balance without the general ledger. You need to have a general ledger, calculate all the accounts, close off where it needs to be closed off, or or you balance the accounts. Then you take the balances to the trial balance. So the trial balance has a debit and a credit. So you need to you also apply the double entry principle, which you apply in the general ledger, also apply in the trial balance, debit and credit. But the difference is that you take the balances as is. If it's a debit balance, you take it to the trial balance and then you put it on the debit side. If it's a credit balance, you take it as is, you put it on the credit side, right? Now the trial balance is divided into two sections. You have the first section, which is the balance sheet section, and then you have the second section, which is the nominal account section. So all the items under the balance sheet section needs to be recorded in the balance sheet. You take them to the balance sheet. Then all the items on the nominal account section, you take them to the income statement. Now you also need some of the balances from the balance sheet section to calculate some of the items in the nominal account section. So it means that whereas in the income statement you put all the items in the nominal account section, you also need some balances from the balance sheet section to calculate some of the amounts. For example, to calculate depreciation, you need the balances of the ledger accounts, the balances of the assets account, vehicle, equipment, etc. And in order for you to adjust the provision for bad debts or the allowance for credit losses, you need the balance that is already there for the debtors, the trade receivable balance or the debtors balance. You also need the allowance for credit losses that's already there in the balance sheet section or the provision for bad debts, so that you can determine whether it's an increase or decrease, whether it's an expense or an income. So that's the relationship between all these. Now you have prepared your trial balance. You need to take all the items to the income statement and balance sheet and cash flow, etc. Right? Now it means that for you to have financial statements, you need a trial balance, and for you to have ratios, you need financial statements. So it goes according to the flow, according to the steps. You have a transaction, that's number one. From the transaction, you identify source documents, that's number two. Now let's talk briefly about the transaction. A transaction is